This episode of The Important Part was recorded on February 24th, 2025. This podcast is sponsored by SoFi to help you get your money right and is for informational purposes only. Nothing in this program is a recommendation from SoFi to you or any listener. You should not rely on this program for any financial advice or legal or tax advice. The views expressed do not necessarily reflect the institutional views of SoFi or its affiliates.
This is The Important Part. I'm Liz Thomas, Head of Investment Strategy at SoFi. Tax season is upon us, and I know nobody likes thinking about their tax bill, but a little planning can go a long way and save you both money and headaches. My guest today is here to do just that. Brian Walsh, also known as Dr. Money, is the Head of Advice and Planning at SoFi. Brian's expertise focuses on three areas: financial planning, thought leadership, and digital advice. He strives to offer not only advice that is meaningful, but practical and actionable as well, which, when it comes to taxes, is incredibly important. Brian received his PhD from Kansas State University's Personal Financial Planning program. He is also a certified financial planner. Before his work at SoFi, he held senior positions in financial planning at TIAA. Brian, welcome to The Important Part. We are here today to talk about such an exciting topic, taxes. But it's that time of year we have to think about it. We have to talk to our listeners about it, and we have to make sure that people are prepared. So you are the perfect person to have here for this. For most people, and even people that just logged into this episode, they're like, snore, right? But at the same time, also anxious. And I don't know if I do my taxes right. I don't know if I'm approaching it the right way. Should I be doing it differently? Can I be saving money? All these questions. And as we know, the tax code is very intimidating. Most people have no idea how to even get through it. So it can bring up a lot of different emotions. I guess first, let's debunk some of the myths. What kind of emotions does it bring up for you?
Well, first of all, thank you for having me on like a riveting topic that people are really like, oh man, I want to hear about taxes. Personally, I don't know. It's kind of like eating your vegetables, right? I don't like vegetables.
None of them?
No, I know that's bad.
Okay.
But I still know I need to eat them.
Yeah.
And I want to be a little bit strategic with it. It's kind of the same thing with taxes. You have to pay it, but that doesn't mean you can't save some money, be more efficient here and there. And ultimately just embracing it as part of your overall financial planning kind of experience.
And I imagine this year especially, we have a new administration. People are having feelings about taxes, but we're not going to know if taxes are going to change probably until much later this year, maybe towards the end of the year. So we're still kind of in this weird in-between time. Why do our listeners have to care? And I guess I would ask that more on an investment standpoint. Why do people have to care so much about taxes?
A couple of reasons. Number one, taxes are really kind of like the perfect forcing function for saying like, okay, let's take a look at our finances. Because a lot of people, it's not just taxes, they ignore all of their finances. Like they don't like to think about it. So you have this great opportunity to say, hey, I'm doing my taxes anyways. Let's take a look and say, okay, what do my accounts look like? What does my allocation look like? What are my goals? How am I tracking? So like using that to really get that benefit out of it. And really the other piece is when it comes to investing, you can be strategic when it comes to taxes. You can pick and choose what types of accounts hold what types of investments. You can look at harvesting losses. You could look at things like making more tax efficient investments. And I go back to early in my career. Actually, when I was working at Baird, which you and I both worked there, which is hilarious, by the way.
Small world.
I know. One of my mentors there, he was like, when it comes to investing, there are really only three things you can control. High level allocation, like how much risk you take. Number two would be the fees you pay. And number three would be the taxes you pay. Like you can't control if the market goes up and down. You can't control individual investments, but you can control those three things. So I think embracing that and saying, how am I going to be as tax efficient as possible is just a way to kind of get excess returns that people don't normally think about. They think about going up and down, their performance, all that stuff. They don't think about how they can be more efficient at taxes and then overall, help their finances.
Well, and one of the ways that I think about it too is even from a strategic standpoint, you're trying to minimize the surprises, right? You don't want to get to April of the following year and have a surprise on your plate that you suddenly have to come up with liquidity to either pay a tax bill that you didn't know was coming, or you could have done something more strategic before the year ended in order to maybe minimize the losses that were there, because you can only carry forward a certain amount of losses. So it's all about minimizing surprises for me as well. So, okay, let's talk about tax season. How do we prepare? How do we plan for tax season? And what would be the best advice? Because at least I know for me, the year ends December 31st, you get to January and you're like, I've got time, right? Taxes aren't until mid-April. And then it sneaks up on you. Suddenly it's mid-March and you realize you haven't done anything. You got to print out, you got to find all the documents. You got to, if you use an accountant, you got to send them to the accountant, or you got to figure out how you're going to do them yourself. You inevitably get stuck at some point not knowing the answer to something. So how do you plan better so that it doesn't become such a last minute anxiety provoking thing?
It's kind of funny because like naturally I'm the biggest procrastinator in the world. So for the longest time, I waited till April, and that's when I looked at everything. Now I do it ASAP. I still don't file them until April 15th because normally I owe a little bit of money. I'm like, I'm going to hold on to that. It lasts a little bit of interest. But I think it's important to start early because you need to decide, do I need help or not need help? And if you need help, you're going to work with an accountant. If you're calling them mid-March, late March, like you are not getting in unless you know them really, really well. So if you don't get ahead of it and you do need help, you're filing an extension and you got to deal with all that stuff. So just getting ahead of it and saying, okay, here's all my documents. Am I going to an accountant or am I doing it myself? That's really important. I think the other piece is by planning ahead, you miss less things. Like two common things that people miss are, number one, they forget about their 1099s for the interest on their savings accounts. Like for the longest time, savings accounts paid like zero interest. And let's face it, like most legacy banks, they still pay like next to nothing. But like now that's actually a decent amount if you're using a high yield savings account. Don't forget about that. The other thing is people forget about IRA contributions, because between January 1st and April 15th, it's like this magical window where you can contribute to last year's IRAs or you can make this year's IRA contribution. So it's a good chance to say, okay, if I didn't max out my IRA, now's my chance. So planning ahead gives you a little bit more time to kind of take advantage of that instead of just saying, oh, I got to come up with $7,000 in 1 week. That might not be feasible, but you give yourself 2-3 months. That's much more realistic.
Well, and the other thing, and this is just speaking from personal experience, if you have big life changes that have occurred in the previous year. So I got married last year. I'm going to have a baby this year, right? Like there's a lot going on. My husband is starting a business. There's all sorts of things happening. So we actually met with our accountant in, I think, November, just to talk about like, how do we not screw this up, right? How do we make sure that we have everything, all the pieces in place? What do we need to have in place? What kind of questions do we need to know the answers to ahead of time? And he helped us through just getting that preparation process going so that the anxiety level came down.
And I would say, like, just to interject real quick, like that example is what every listener should be doing. Because you think about it, you have like a major life event. Planning ahead and getting ahead of that, talking to an accountant, talking to a financial planner about benefit elections. I know we're talking about taxes, but those types of things, getting ahead of it rather than waiting to like, oh, shoot, last year I had a baby. What do I do? You can't really be as strategic as if you just proactively get ahead of it.
Speaking of a baby, apparently you have to choose the name before you add them to the benefits. We're struggling with the name thing so far. So
I mean, Brian's a great name. I mean, I'm just throwing it out there, you know.
We have to figure that out ASAP. Okay, so this is something that I think is interesting for people to know. And this is like inside baseball. What are some underrated or underappreciated tips that you can give people for tax time? I mean, I think everybody knows the basics, right? Like know how to prepare. You got to know what your income was. You got to know what your investment gains or losses were. You got to know what your student loan interest was. If you have a mortgage, you got to know that. The big stuff I think people understand. And then you have to choose whether or not you're going to use an accountant. Is it worth the fee? But what are some underrated, unknown types of tips?
I think when you're doing your taxes from the prior year, there really isn't all that much you can do because that year had already passed. So like outside of like making an IRA contribution for the previous year, there's not a ton of things that you could do. You take advantage of all the deductions you can, you make those decisions. But I think what you should really do is plan ahead for next year. Like look at what you're paying in taxes. And then you say, okay, is there a way I can be more efficient in my investments? Like maybe I have a ton of gains. Okay, should I trade in, let's say, my IRA instead of my taxable account? Or maybe you have a ton of interest income. Okay,
Mhm.
should I have that in my IRA, my 401k instead of my taxable account? Or even if let's say you have mutual funds, like, am I seeing a lot of capital gains distributions, even though I'm not taking any money out? Should I change to ETFs instead of mutual funds? So I think it's more getting ahead by looking at it rather than saying, okay, I'm going to scramble last minute and I'm going to save thousands of dollars in taxes. Like,
Right.
that's not all that realistic. It's about learning from last year and saying, how can I course correct for this year to be more strategic? So that way next April is going to be a more pleasant experience.
So let's talk through the decision of whether or not to use an accountant. Obviously, nothing comes for free.
Yep.
There are endless amounts of services out there, online services that'll take you through step by step. And we all know what those are. Or you can have an actual person and you put on your tax return, so and so was responsible for filing this. That person signs off on it. And you sort of just hand everything over to them and they take care of it. How do we decide when that's helpful? And maybe even more so, how do you decide what's a fair price to pay for that? Because it runs the gamut.
Yep.
You could pay thousands of dollars and maybe get ripped off, actually, or you could pay much less and feel like, you know what, that was worth every penny for me to not have to worry about it.
Some of the key situations we look at is, like, number one, business owners.
Mhm.
I feel like that's kind of obvious, but if you own a business, you should be working with an accountant. If you are a high earner, like, let's say you're in the top couple brackets, like,
Mhm.
taxes have a much bigger impact. So even small changes can be a bigger difference.
Mhm.
If you are going through major life events, like with your example, buying a house, having a kid, all those types of things, that
Mhm.
way you could ask those questions. Not saying you're going to need an accountant forever. Then maybe you could, move to online.
Mhm.
Um, I would say, like, those are the big events that kind of come up
Mhm.
when you're deciding, hey, do I need to reach out to someone? The other area that's probably overlooked would be people have a lot of equity compensation, because
Mhm.
that's something where that can really surprise people.
Yep.
When you're vesting every quarter, or most of the time it's every quarter, how does that impact my taxes? Especially if you have, ISOs or NSOs, those are definitely more
What are those?
incentive stock options or non-qualified stock options. So, like,
Uh-huh.
if you have equity in the form of options,
Uh-huh.
that's going to be more complicated than equity in the form of RSUs. You'll
Which is
probably,
restricted stock units.
yeah,
Mhm.
restricted stock units. And it's just like those types of things. If you get equity comp and it's a good chunk of your compensation, you probably should work with an accountant.
Yeah.
I think, price point, a lot of it depends on your geography. Like, I live in rural Michigan. I mean, I would probably expect to spend, maybe 500, $1,000 working with a good accountant.
Mhm.
New York City, San Francisco, LA, Chicago, like, that's going to be a couple of $1,000s higher just because everything else is. The other thing we encourage people to do is, if you are in that bucket where maybe you're an executive, you get a bunch of equity comp, you're a business owner, really establishing that relationship where it's not just like a one-time transaction, where you can then work with them throughout the year and really get that proactive insight to make it worth it.
Yeah.
Because, I mean, filing taxes once, that's helpful,
Right.
but it's really the ongoing insight and advice that adds value and ultimately will help you reduce your taxes the most.
And I'll tell a personal story here so that if there's anybody out there listening, don't feel intimidated and don't feel upset with yourself if you don't understand taxes, because I've been in investing my entire career. I'm no accountant, and I thought that I was smart enough to figure out how to do my own taxes. So I'd been doing my own taxes forever. And then at some point, I forget exactly which year it was, somewhere in the 20 teens, I still had student loans. And I was entering in what I thought was correct, my student loan interest, because it was what the online system prompted me to put in that box,
Yep.
right? So I put in the number in that box. Well, it turns out I had been recording it incorrectly for a couple years. And not to mention, then I had some RSUs at my previous job that were reported kind of funny. I thought I had entered it in the right box. Long story short, I screwed up my own taxes like 2 or 3 years in a row. The IRS figured it out for me.
Isn't that so nice of them to
They're
help
so
you out,
great.
right?
A few years later, and sent me a letter like, hey, we think you screwed up your taxes. And I didn't know how to fix it. So I had to go get an accountant to fix my taxes first and figure out what I had done wrong with the student loan interest. Now, luckily, I had sort of overclaimed one and underclaimed the other, so it turned out to be kind of a wash. And it wasn't that, these were not big dollar amounts. It wasn't that big of a deal. But that was the moment that I realized, you know what? I'm probably not qualified to be doing this because I don't know how to catch my own mistakes. I don't know what looks right and what doesn't look right. So I handed it over to the professional and I just said, you know what? This has to be yours now because I don't want to get any more letters like that and try to figure this out on my own.
Realistically, the good news is, though, since 2017, there really haven't been that many changes as far as taxes are concerned. Now, like you mentioned, new administration. So like, let's say if there's major changes to the tax code, then I think we'll see more people needing to reach out and get help. But I mean, having it be relatively status quo for the last few years does make that a little bit easier. So you don't have to pay attention to tons of new things.
Is there not much that changed from 2024?
I mean, like you're going to have the normal changes, like the income ranges for the different brackets goes up a little bit for capital gains and for income. The IRA contribution limits change a little bit, but it's all like minor things. No real like wholesale changes like we dealt with, let's say 4 or 5 years ago.
Okay, let's get into the investment side of things a little bit and just talk about different account types. So we've got taxable accounts versus tax advantaged or non-taxable. They have all different names, but they all mean the same thing.
Yep.
So we've got like a taxable brokerage account, perhaps from an investment standpoint, or you've got a tax advantaged account, which would be something like a 401k or an IRA or a Roth. Let's start with that. Let's start with a Roth versus a regular IRA.
Okay.
How do you decide?
The easiest way to think about this is like a Roth IRA, you are going to pay taxes on your income. And then you're going to contribute to a Roth IRA. It's going to grow tax-free. Assuming you follow the rules, you take it out tax-free. Traditional IRA gets a little tricky. Sometimes you can make deductible contributions. So essentially that would be, you don't pay taxes on that income. Sometimes you make after-tax contributions, grows tax-free. And when you take it out, you pay taxes either on the whole amount or the gain. I think like the best analogy is like with a Roth IRA, you're paying taxes on the seed. With, let's say, a 401k or traditional IRA, you pay taxes on the harvest. Now, when I say that, everyone's like, okay, Roth IRA, that's definitely the way to go. For a lot of people, it is. Let's say you're a long time away from retirement. You plan to be in similar like lifestyle when you're in retirement. Roth IRA makes a lot of sense because tax-free growth and tax-free withdrawals are powerful. On top of that, most people in their 401k, they make pre-tax contributions. So you're already going to have a big bucket of money in retirement. Then whenever you take it out of the 401k, you're paying taxes.
Right.
So Roth IRA can be really, really helpful for people. Where it's not, I would say like if you're close to retirement, or maybe if you're in a really high bracket now and you're like, my lifestyle in retirement going to be much lower. Like you live well below your means. Maybe a traditional IRA makes more sense than a Roth IRA.
You hit limits too, right? There are limits where you actually can't contribute to a Roth IRA.
That's always been like the funniest thing for me because yes, to directly make contributions to a Roth IRA, you have to make below, a certain amount of income, but you can do what's called a backdoor Roth where there's no limit on doing a Roth conversion. So let's say you make $500,000 a year. You can't directly contribute to a Roth IRA, but you can contribute to a traditional IRA and then convert that to a Roth IRA. There's some nuances you need to pay attention to, but like there are limits, but that's kind of like a loophole. I'm surprised it hasn't been closed yet.
Yeah.
I don't understand why it hasn't been. I take advantage of it. It's great. But yeah, that's the interesting thing about Roths right now.
One of the things that I do, because I have an IRA and a taxable brokerage account. One of the things that in case this is helpful for people, I trade my own accounts. So I have a financial advisor, but that's sort of for other purposes. I trade my own accounts. If I can help it, if the money is available and I want to make a trade that I think might be a short-term trade, I try to do it in my IRA because who knows what's going to happen, right? Maybe it's going to kick out a huge gain, but I don't want to hold it for more than a year and let it turn into a long-term gain. I know I'm going to have to take a short-term gain or loss. I try to do that stuff in my IRA as much as I can. And the other investments that I know are going to be more long-term, I try to do in the taxable brokerage account because I have more flexibility that way where I can wait for things to hit that long-term status at a year. Likewise, we're early in the year now, and actually you and I have worked on this in our robo platform. We're early in the year now. How do you think through strategically how to prepare for possibly having gains at the end of the year, right? So we're sitting here, we're recording this in February, this will drop in March. If I'm thinking to myself, okay, I've got this investment in my taxable account and it's down 7%. Do I get rid of it and hold on to a loss for a little while, knowing that maybe later in the year, or hoping that maybe later in the year, I'll have a gain that I want to offset? It's, how do you think through that decision? Because once I sell it, it's locked in as a loss. And the regret of that sometimes is just so overwhelming.
This is interesting because we're kind of combining like, okay, what type of account should you have for what purpose? And then when you're within a taxable account or a brokerage account, how can you be more strategic in like harvesting losses to offset gains? So like hitting on the tax loss harvesting piece, realistically, if you could take advantage and harvest a loss, which means you're selling and you're saying, okay, I have a loss, I'm recognizing that. So I kind of lock in that loss. That can be used to offset future gains. You can also take up to $3,000 that you could use it, against your income. So there's tons of benefits to doing that. Now, to your point, the problem is, what do you do with that money? Like when you sell, you're going to put it in cash and you're like, oh man, the market went up. Now I'm horrible idea. Do you put it in something else? A lot of times, like with the robo, for example, you want to look at putting that money to work in something that is substantially similar, but not identical. So it can't be the same exact thing. Okay. So you can't take it and say, okay, I'm moving it from, I don't know, SPY, which is SP 500 index, to VU, which is another SP. It's like, those are the exact same things.
Yeah.
But it can be very, very similar. So maybe you, S&P 500, maybe you sell SPY, and then you decide to put it back in maybe, I don't know, a large cap growth fund, for example, where it's very, very similar. You still harvest the loss, so you could use that in the future. And then you keep, pretty similar exposure, so you're not losing that position. So I think that would be the approach to take with it. The key there is there's what's called the wash sale rule. So wash sale rule is what complicates all this tax loss harvesting fun.
They have figured out a loophole.
I know. So it's basically you look at 30 days on each side of that trade. So if you're going to sell something, you got to look back 30 days in the past. Did I buy it? And then 30 days in the future, am I going to buy it? So you just want to make sure you don't put money back in that same security.
You don't get to use your loss.
Yep. It essentially wipes it out.
Until you sell that new lot.
Yep.
Right.
Yep.
Yeah. And that's something that I think people don't figure out. That's one of those surprises that you want to minimize, where you thought you could use a loss to offset some gains. You get to the end of the year and realize, wait, what? Because I did it 20 days later, I can't use this. Yeah. So that's one of those surprises you want to minimize for sure.
And then to your point earlier, like the IRS on your tax forms, they're not going to tell you that because let's say you have accounts at different places. They're not going to tell you, hey, you violated the wash sale rule. You're going to sit there and you're going to think that you abided by it. And then let's say you get audited. Then the IRS says, hey, hold up a minute. You violated the wash sale rule. So I think I'm a big fan of consolidating accounts for a number of reasons. That would be one reason. It makes taxes easier. You can keep track of things. Because the wash sale rule catches a lot of people by surprise.
One of the things that I think is important to talk about too is taxes are obviously not the only consideration that you take when you're investing and deciding to sell something. So again, I'll give a little bit of a personal example here. If you've got a position in your account, taxable or non-taxable, doesn't matter. First and foremost, make a deal with yourself about how much you're willing to take in pain. If you've purchased a position, you felt really strongly about it, you liked it, you thought it was going to go up, and it's down 10%, and you've made a deal with yourself that you won't let it go below 10%, stick to your deal, right? Don't get married to the position. Does that mean that you have a loss that you now need to do something about? Yes, later in the year, you got to figure out what to do with that loss. The difference is so many people get caught in this, and I've gotten caught in this myself. You get so convinced that a position is going to do something that you want it to do, and then it doesn't. And it's down, and all you do is stare at that position in your account and just hate it, right? And it drives you crazy. It keeps you up at night. And I can tell you, every single day that you spend hating that position is an opportunity cost that you're spending of what you could do with the money otherwise. Now, is it less money than you put into that position? Yes, unfortunately. But it also isn't just sitting there tormenting you for the entire year. And it's not sitting there maybe even going lower, right? So if you decide on whatever your sell rule is, 10% down, 15% down, 20% down, doesn't matter. There's no right or wrong. You just make a decision. You sell it and then later figure out, okay, how do I want to use this loss? Right now, yields are high. Put it in cash. You get paid to sit in cash right now. Put it in a money market. If we're talking about a taxable brokerage account, you have to pay taxes on the interest that you're going to gain on that money market, but you can just park it somewhere for the time being. So that's just sort of a PSA. It's not just about taxes. It's also about making sure that you have peace of mind in yourself, in your investments.
The flip side of that scenario is also very, very true. Like you never want, like taxes are the tail, your investment strategy is the dog. Like the tail, you never want the tail to wag the dog. And like, if you think about it, I see a lot of people who have concentrated positions and they're like, I'm not selling. I don't want to pay the taxes, because they have a big gain built up into it.
Yep.
And so they're over concentrated because they don't want to pay taxes. They're taking on too much risk. And then all of a sudden the stock goes down and they're like, oh shoot. So because they're trying to avoid paying taxes on it, they kind of get out of whack with their investment strategy because of the gains. So it's like both sides of it influence people's behavior. You want to follow your investment strategy first and foremost, and then taxes kind of come secondary.
Because otherwise you get into that you're trying to time the market, and we all know that doesn't work very well.
It doesn't. If you had tips for me, I would love that.
If I had figured this out, most people like me wouldn't have jobs, right? If there was a good answer. Long-term planning. Let's talk about financial planning long-term and just money habits in general. So we'll get away from the tax topic. I know everybody is just heartbroken that we're going to stop talking about taxes for a second. But let's talk about how do we effectively plan long-term, because you also are a certified financial planner and you have conversations with people about this all the time. All of our SoFi members, people come to you for this type of advice. So first of all, what's a philosophy? What's a good philosophy to abide by for financial planning?
People make financial planning way more complicated than it needs to be. I think in my mind, there's 3 rules. Pick one thing to focus on. Only one thing, because if you focus on more than one thing, you're not going to make progress. And if you don't make progress, you're not going to stick with it. Pick the right thing to focus on, because there's always going to be the best use of your next dollar, whether it's paying down debt, saving for retirement, saving for a short-term goal. Pick the right thing and then automate everything you possibly can. I think too many people, they try to it's like on a diet. Like they try to use willpower and grit their way through accomplishing a goal. And for 99% of people, that's not going to work. Versus you automate it, you make a good decision once, you reap the rewards on an ongoing basis. You don't have to use your emotional, power and all your willpower and everything to make that decision nonstop. Like if you pick one thing, you focus on the right thing at the right time and you automate it, like your finances are going to be in a good spot. It's not all this complicated stuff. There's books and everything. And yes, I have a job making things more complicated. But if people just did those 3 things, their finances would be in a good spot.
Well, it takes the decision fatigue out of it. You get to a point of decision fatigue. And another way I think you get to decision fatigue is budgeting. You can budget. And I'm completely guilty of this. I have spreadsheets. I have very advanced spreadsheets built about my own financial situation and how to budget and where all the different buckets that the money goes into. But you do get to a point of decision fatigue and you just end up moving things from one cell to another cell and it's all linked together. At the end of the day, it's really what we were talking about, what you just answered before. Put the right habits in place, set your goal, know that you're working towards your goal. But let's talk about how people can budget, because you have to have some sort of framework, right? You can't just sort of go into it without thinking about it and spend your money on whatever you want and expect that it just keeps coming and it just arrives.
That'd be way more fun.
Miraculously, it all happens and it all works out. So how do you budget without getting yourself too far into the weeds?
So what's funny is you and I are the polar opposites when it comes to budgeting. And I think that's representative of the fact there's no one size fits all when it comes to budgeting. At a high level, there's 3 camps for budgeting. There's a line item, which would be your spreadsheet, where it's you list out all the categories, you have a target, you track it, it's intense. Then you have the middle group where you have high level categories. I think of the 50-30-20 budget, where you have 50% of your spending goes to essentials, things you have to have, 30% towards discretionary, things that you want to have, and then 20% towards your goals. And then on the far end of things, you have a spending target, which is what I do. And I'm okay, I know that I could spend X amount of money a month. If I do that, I'm good. And all three of those approaches work. So like if you have spending trouble or you're super analytical and it makes you happy, then do the line item budget. Like that's great. For everyone else like me, I hate thinking about money in my personal life. Like weird profession, I know.
Yeah.
Like I just truly, it gives me tons of stress and anxiety. So the less time I spend focused on money, happier I am and the better decisions I make. So if I have just one target, I check my SoFi app. It's actually how, Relay works. I'm like, I set my spending target. I'm like, oh, am I good? Okay, cool. Check in once a week and it makes me feel happy. So like find out what approach works for you and your personality and then just do that. But don't always overcomplicate it, because like the spreadsheet approach for me, I tried it. I didn't do it because it took too long. And I ended up ignoring my finances. I'm like, that's not good.
Yeah.
I had to move to the spending target. Otherwise, I was taking what you said, like, oh, let's just spend money. And I just wasn't tracking it.
How can people stick to a saving plan? Because I think that ends up being, especially at certain points in your life. I know for sure when I was in my 20s and even early 30s, and you feel like you're living, you're kind of just piecing it together, right? Yeah. Savings is the first thing to go. If you've got an expensive month coming, it's like, well, okay, I guess I'm not going to save as much this month. How do you stick to that? Because it becomes a bad habit of saying, okay, well, this month I'll just put that by the wayside. I won't contribute as much or whatever. And then you find yourself 8 months down the road and you haven't done it for 8 months. And then it's 2 years down the road and it's like, whoa, I'm really far behind. So how do you tell people to stick best to their savings plan?
I'm a big believer in mental accounting, where you have different accounts for different purposes. And a perfect example of that is for my emergency fund. I have my emergency fund in money market funds. Not advice, not saying everyone should do that, but that's where I keep my emergency fund. And that's in my brokerage account, completely separate than my checking and savings account. So if I have a month where I'm overspending, I look at my checking and savings account, I'm like, oh gosh, that's getting low. And it causes me stress. And then I reduce my spending. Whereas if I kept my emergency fund in my savings account, I wouldn't feel that stress and I would be dipping into it. And I think doing that allows people to kind of say, okay, emergency fund, maybe you're saving for a down payment, separate account. Keep your accounts as separate as possible and then have money automatically going into that from your paycheck, because it kind of puts it on, on autopilot, and then it allows you to view it separately so you could track it. And then you get stress or anxiety when you touch it. And most times, like stress and anxiety, that's a bad thing. At the same time, it can be very, very helpful. Like if you think like cavemen, like they saw like, I don't know, like a woolly mammoth or whatever, they get stressed or anxious. They're like, oh shoot, I should run away. Like, so that's like, that's healthy. Same thing with finances. I need that to say, okay, my checking account's getting low because my emergency fund's separate. That stress or anxiety stops me from buying stupid things, and it reins my spending in.
What are stupid things? Like the things that you on your Instagram algorithm that come across and you're like,
gosh,
you know what? I do need a cup that stirs the coffee itself. That sounds right for me.
My guilty pleasure, this is going to sound so nerdy, football cards.
Football cards.
I collect football cards.
Oh.
Yeah. And I got my son into it too. I'm sorry for his future finances, but I love football cards. It's like a good hobby I kept from my childhood. So yeah, that's where if I overspend, chances are it's football cards.
That's probably an okay habit. All right. So
not according to my wife.
Yeah, we're right. I mean, my dad has a real baseball card habit, so I can sort of empathize. Let's finish this off with some short-term versus long-term goals, because you've talked about keeping things in separate accounts. You've talked about when you think about planning, choosing the right goal and focusing just on that. But inevitably, people are going to have some competing priorities, some of which are short-term. And in my world, we would talk about liquidity events. If you need to have liquidity for certain things coming up in the next year or so, that would be something that you probably don't want to put that in a long-term stock investment, because you're going to be forced to sell it at a certain point that you may not want to sell it. How do you balance those short-term goals with long-term goals?
I think it depends on what short-term goal it is. I would say like a short-term goal would be having enough cash for unexpected expenses. That is one of the most important things that someone should focus on. Like if you don't have an emergency fund, 3 to 6 months worth of expenses, like you are living life on the edge, quite frankly. If something bad happens, you're going into debt and you got to dig yourself out. So I'd say like that takes priority over pretty much anything else. On the flip side, like retirement's a long-term goal. that should take priority over most other short-term goals. Like you should be on track to, saving for your retirement before you look at other short-term goals like buying a house, sending your kids to college, those types of things. So I think it's about prioritizing which one and saying, which one's gonna be more important.
Well, and you have a really clean decision factor, and I like this. I hope that you're going to answer it the way that I want you to right now. I'm going to tee you up. But let's say somebody has a lot of debt. Let's say they have credit card debt, and that credit card debt is running at an 18 to 22% interest rate. But they also don't have an emergency fund yet. And they also want a new car. There's all these different competing goals. So we've got credit card debt at, let's call it 20% to keep it clean. We've got an emergency fund that's only about 50% to goal. We've got maybe a 401k that we could contribute to through our employer. And then we've got a discretionary item like a new car. What do we tackle first, or do we somehow do all four at the same time?
You definitely don't do all four. Because if you focus on four things, most people, you're not going to make progress, and you say, forget it. I'm going to buy some football cards because I'm not making progress anyways. We prioritize and say, okay, number one, do you have 1 month's worth of cash set aside? Okay. If you don't, you do that.
That's first.
At all costs.
In this scenario, that's first no matter what.
Yeah, that scenario. Okay. So if you're at 50%, let's say you have that cash, cool.
Okay.
Next step, are you taking advantage of your 401k match? Because that's free money. Like a lot of people don't look at it that way, but it's part of your comp, like probably the best return you're going to get on investment, like 50% or whatever it's going to be. So if you're not doing that, then that's where all your focus goes. If you are doing it, then you move on to the debt. Okay. Bad debt. If anything over, 7-8%, like that is really expensive.
Why
debt.
7-8%? What's that threshold about?
I mean, that's the long-term inflation adjusted returns of the market.
Got it.
So it's basically like you have a decision. Do I want to invest or do I want to pay down debt? And if your debt's expensive, 10, 15, 20%, you are not going to earn that in the market.
Got it.
Consistent. I mean, you could in 1 year, but consistently you're not going to earn that.
Right.
So you should pay down debt. Flip side, let's say, I don't know, I thank the lucky star. Like my mortgage is like 2.6. Zero chance.
You're never moving, by the way.
I know. But I get, my wife and I get in that debate all the time.
Yeah. And you're not alone. Most of America is in that bucket.
Zero chance I'm making an extra payment on that debt because shoot, money markets are paying more than that, let alone investing for the future. So in this scenario, you pay down the bad debt. Once you got that taken care of, then you build up your full emergency fund, 3 to 6 months worth of expenses. Then you focus on retirement savings above the employer match.
Okay.
And I would say, 75-80% of the people we talk to, those first 6 steps, that's what they're focusing on.
That's what they need to do. Yeah. And once you get, and I think that's true, you try to focus on too much at once, you end up getting overwhelmed, and it's like, I'm not making any progress on any of these, so I give up and I'm just going to go do what I want. Yeah. And then the goals sit there untouched, and you find yourself, like I was talking about before, 2 years down the road, like, oh my gosh, what have I done? Right. 100%. And you don't want to end up in that scenario, because trying to dig out of a hole is much harder than trying to just kind of chip away slowly. Okay, well, that's the bulk of it. We've finished these episodes with some segments.
Okay.
And we do them real short, just to sum it up. So the first segment is the word. Sum up tax-efficient investing in one word.
Okay, I'd say force multiplier.
Forced multiplier.
Force multiplier.
What do you mean by that?
Because it's like, if you are investing in a tax-efficient manner, then you're going to have excess returns based on your contributions. Because if you're not paying money in taxes, that's just more money that's allowed to grow. So it's kind of like, I'm a dork. I like military movies and stuff like that. You look at certain units and everything that are like force multipliers, where it's not just like the 10 people they have out there. They really they battle like they're like 50 or 100 people because of how skilled they are. Like that's tax efficient investing. I don't know. That's what I think of, because it allows more of your money to grow, and compounding growth is the most amazing thing in the world.
The power of compounding. Yeah. And that is very powerful. Okay. What was your aha moment? When was the moment when you realized you wanted to turn financial education into a career?
Honestly, it's when I messed up my own finances.
Oh.
So I was a finance major. I knew everything that you should be doing. Like, I had no excuses. And I was horrible at managing my own money. And I woke up and I was like, oh crap, I got a ton of credit card debt. I don't have savings. Like, what is wrong with me? And I'm a nerd, so I started learning about behavioral finance and how people make decisions. And I used it to fix my own finances. And I'm like, wow, if I messed up this bad and I know all the stuff, most people don't know the stuff I know. Like, that's where I'm like, okay, this is like really cool to learn how people make decisions and how you can kind of influence those decisions.
Isn't it funny to read some of that stuff, the behavioral finance stuff, and be like, oh my God, they can see into my soul, right? How did they know that that's what I did? How did they know that that's what I fell for? And you do, especially in this industry, you do get surprised that you fall for stuff, right? I mean, I talked about my tax thing before. That was such a simple thing to have figured out. I didn't know that I did it wrong. And I still fall victim to the behavioral finance, the behavioral investing stuff from time to time. And it's very frustrating. So it is important to admit your own weaknesses, admit your own limitations, and then learn ways to improve all the time.
And it's important for other people too, to see experts make mistakes.
Screw it up.
Because they get people get ashamed. They make bad mind decisions. They get ashamed. They don't talk about it. They beat themselves up, and it affects their future. When in reality, even the experts make mistakes, and it's just whether or not you learn from them.
Well, and the stories that you hear from people are the good stories, right?
I bought, like Instagram.
I bought X stock when it was, $2 a share now, and I've become a millionaire on it. Or I bought Bitcoin when it was way back in the day. You don't usually hear the horror stories. So you hear these amazing stories and then think to yourself, well, how come I didn't figure out how to do that? And then you get insecure about it. And it's just this never-ending cycle of just paralysis of now I shouldn't do anything. Okay, last one. Best or worst trade. What has been the best or worst investment you've made in pursuit of a long-term goal?
The best is like 6-9 months ago, I put some money in Artie and Tesla. Worst would be every other trade I made. Like, I'm not a trader.
Everything else.
I have maybe like 1 or 2% of my overall portfolio where I trade because I know I'm bad at it.
Okay.
But I like to do it. It's more like just play.
Yeah.
But I know that I'm bad at it. So like all of my real money is just diversified long-term investing.
See?
Just like
know
a
your
robo type approach.
Know your limitations.
So yeah, I'm on a heater now with my last 2. So that means I should probably just sell and like move the cash because I'm due for a bad one, I suppose.
Hopefully that doesn't happen to you, but thank you for sharing. Thank you so much for being with us today. I know that this was not a topic that everybody is dying to hear about, but it's important. It's very important. That's why we wanted to bring this episode out and bring more attention to it, make sure that people are prepared and thinking about it. And this is also a great time of year to be thinking about your planning even for next year and get ahead of it. It doesn't just have to be a New Year's resolution. You can do this in February. You can do this in March. And there is no too late. So thank you, Brian.
Yeah, thanks for having me.
So to wrap this episode up, tax season, as boring as it may sound, is actually a perfect time for people to take a look at their finances. And some big takeaways from this episode. First and foremost, the financial planning philosophy that Brian talked about, and the idea of just pick one thing to focus on. And as long as you've chosen the right thing, you can automate everything else and let it work for you. I think that was a really important piece of advice and one that everybody should follow. Second big takeaway was budgeting. There is no one size fits all. And this is also really important because I think people beat themselves up over, oh my gosh, I don't budget the same way as somebody else does, or I'm not doing it all the way through, or I'm not being as thorough as I should be. Maybe that doesn't work for you. It is important to have some kind of approach. And he listed out a couple of different options and ways to do that. But budgeting is not one size fits all. Just do what works for you. And then the last piece that I think was important was to balance your short-term with your long-term goals. Things like having an emergency fund and prioritizing that first, and then prioritizing your retirement, and then prioritizing paying off bad debt. Things like that, putting that in place and having the right priorities so that you can meet your goals, both short and long-term, and feel like you're moving in the right direction. So thank you very much for listening, and we look forward to bringing you the next episode very soon. For more from me, read my weekly column every Thursday on the SoFi blog or follow me on X at Liz Thomas Strat. Follow The Important Part wherever you get your podcasts. The Important Part is produced by SoFi in partnership with Pod People.
The views expressed do not necessarily reflect the institutional views of SoFi or its affiliates. This program should not be copied, distributed, published, or reproduced in whole or in part or disclosed by any recipient to any other person without the express written consent of SoFi. Each name of any organization mentioned in this program is the property of the company to which it relates, is used here strictly for informational and identification purposes only, and is not used to imply any authority, ownership, or license rights between any such company and SoFi. The content of this program is not a recommendation from SoFi to you or any listener or recipient of this program, and is provided for informational purposes only. SoFi is not providing any financial, economic, legal, investment, accounting, or tax advice through this program, or to its recipient, and you and any person should not rely on this program for any advice. Investment decisions should be based on specific financial needs, goals, and risk appetite. SoFi has no obligation to provide updates or changes to the information in this program. Past performance of any investments mentioned does not guarantee future results, which may vary. Neither SoFi nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information contained in this program. Any liability for any statements in this program is expressly disclaimed by SoFi. For additional disclosures related to the SoFi Invest platforms described above, please visit sofi.com/legal.